everyone. Can you hear me? Yes? Yeah? Good. Welcome back. For our last session of the day, we have a topic on the evolution of money and the future of blockchain. Please welcome Mr. Thamim Ahmed, digital asset researcher for the London School of Economics. Welcome, Thamim.
They're just getting my presentation up, so it'll take a minute. How's everyone's day been? Good? I just want to get a feel of the room. How many sort of people have and own cryptocurrencies here? Okay, one or two. And how many actually understand the fundamentals of the technology behind crypto? Yeah? Okay, nice. So the talk, once it does hopefully come up, it's going to be a little bit of a 101 on the foundation. Lovely, thank you. I just ran over from the hotel. It's going to be going over some of the basic principles and then sort of talking a little bit about where DeFi is, decentralized finance, and what's going to happen next for it. Just a bit of background and context. I've been in the crypto space for about 10, 12 years now. I'm a researcher at the London School of Economics, and a lot of my core research is on how institutions use distributed ledger technologies, as well as sort of working with a number of startups in how they address the permissionless space from a regulatory standpoint. So quite knee-deep. If anyone wants to talk any sort of advanced questions or discussions, feel free to approach me. I'm just waiting for the presentation. So how did you all get into crypto? Show of hands. Yeah, let's go with yourself. What was your interest? Investing. So just make a lot of money, huh? All right, like that. It's losing all, yeah, it's a bit of a bear market. Right, and how many people are actually in the enterprise space? Oh, here we go. Is there a clicker by any chance?
So
right.
the clicker.
I think we're quite advanced
hello,
here.
hello.
We're using Bluetooth technology through my voice.
Hello.
I'll have a system, beautiful system there.
Thamim, the clicker is not working. Just tell us when to click.
Right, got you. Perfect. Okay, so let's get started. As mentioned, Thamim at the LSE. If anyone's on Twitter, feel free to kind of follow me. Next, please. So there was this dichotomy at the beginning of crypto. We're talking 10, 12 years ago, where a very niche group of people, they were typically living on the Reddit forums, and they were like, wow, this blockchain stuff, let's take out the evil bankers who are sort of getting all the money and not sort of distributing that wealth. But lo and behold, what they had actually invented was this distributed ledger technology, which is a fair bit of, in summary, a shared ledger, a shared database between a number of participants who don't necessarily need to know each other. So what I spent probably about 5 years of my life doing is speaking to bankers, regulators, central bankers, educating them on this. Typically coming out, wow, what is this blockchain thing? And can we just solve it as a solution to all of our problems? The answer is no. There has to be a bit of a private and a public discourse that sort of takes place. And I believe rather than calling this space Web 3.0, we're more like at a Web 2.0, where you do need trusted parties within a decentralized ecosystem to move technology and existing public markets forward. Next, please. So by the end of this sort of discussion, we kind of want to summarize. This is a bit of a Venn diagram where money stands at the moment. It's called the money tree. And essentially, there are 4 main buckets where you have widely accessible money, then you have peer-to-peer money, and then you have central bank digital money, which is actually issued by a central bank, and then you have sort of virtual money or digital money or internet magic money, where this sort of cryptocurrency sort of came from. Anyway, that's a bit of a broader ecosystem of what we're going to achieve, and hopefully you're going to have a bit of an understanding on by the end of this 25 minutes or so that we have together. Right, next please. This is a quick sort of overview. Next please. Right, so everybody has a bit of money in their pocket. Can somebody tell me what is very unique about this sort of bit of paper in your pocket? What's unique about it? What's common on all these currencies? What's that? It has value. Okay, right. How do you know it has value? Yes, please. Okay, how are they centralized? Sorry?
They are all controlled by one individual countries.
But how? How? Where, you know, like how? What's common? What do you see as common? Oh, we need to update this picture now. What's common across this? All of these notes?
Well, they are fiat currencies, the paper notes.
Okay. What else can you see? Like just from an observation perspective. Design. Okay. All okay. Physical. Talk to me more about that. How is the physical and the digital connected here?
There is a
Owned by a
in
bank?
every currency note.
Okay, I think I'm going to have to help you out here a little bit. If you notice on all the notes, there is a number there. All right, next slide, please. You see there's a number here. It's an identification. So what this identification basically means is, could I have a mic, please?
Yeah, right here, coming up.
I'd like to walk. All right, brilliant. Can you all hear me? All right, fantastic. So what this number basically means is, if any of you have money in your pocket right now, you can go back to your central bank, and it's issued directly by the central bank, and you have a claim on that note. They'd have to give something back in return from that. The major difference is all of us use sort of mobile digital banking right now. Those dollars, dirhams, pounds, whatever we have in our pocket on our mobile apps, they're not issued by the central bank. There's an intermediary sort of retail bank or an investment bank behind all of that. So this is a core thing I'd like you to kind of think about as we sort of talk a little bit of the background of the technology. Next slide, please. So just a 101 sort of stuff. What is a ledger? A ledger is essentially just a table of a list of transactions. What is a transaction? It's a unit of work resulting in a state change. A state change in the actual ledger. So you've upgraded the ledger in itself. Okay, next, please. So just when we look at the history of ledgers, they're nothing new. They go back to clay tablets, some of the first ledgers. Then we had, during the Greek period, they used to use papyrus to audit and collect tax. Then during the 16th century, the treasury in the UK, when they ran out of money, they were giving these things called tally sticks. Essentially, it's two bits on a stick, where if you had the broken part to one side, you'd be able to claim against the treasury on the other side. And as we sort of evolve, something that we do on a day-to-day basis, all of us will probably have an Excel sheet. It does some form of accounting. All blockchain technology or Web 3.0 it's just an evolution really in the accounting technology. And the main differentiator is we've got to a stage right now where we all have multiple copies. So if I want to change an Excel sheet, I'll change it, I'll share it with my whole team. This is a bit like everybody will have the same database, but everybody doesn't need to know each other, and everyone can see the changes on the ledger itself. So next, please. So for essentially, if we look at a macroeconomic, if we sort of think about all of our Excel sheets and we get really deeply philosophical, we can say all of our Excel sheets have some sort of impact on the day-to-day economy and the lives that we run and live. So it can be sort of put quite nicely into this. Ledgers provide an underlying infrastructure for exchange by allowing actors to prove, validate, and verify the property of ownership. I'll show this in a bit more of a graphical sort of representation in a minute, but what I'd like you to understand is your Excel sheets are really important because they move value throughout the economy. So let's just have a look at actually how does this sort of happen. Next slide, please. So yeah, just a summary. Sort of ledgers confirm ownership, they confirm identity, they confirm status, and they confirm authority in summary. Next slide, please. So we have markets on one side. Next slide. And markets typically have money or value that's in those markets. Next slide, please. And they typically have contracts. So if we have a business agreement, we'd have a contract that's set up in order to move that value from one company to another in that market. Next slide, please. And that's typically in a well-defined sort of business market that's defined by a set of laws. Next slide, please. Which is defined by a governing body. Next slide, please. And essentially, that's how you create different sort of markets. Next slide. Just slowly carry on going with these slides, please. And then as we move value from different markets, it just happens by the movement of contracts between those markets. All right, and that's how money and value move within sort of macroeconomics of things. Next slide, please. And essentially, that's how the government gets their money, by having legislation and law in place in order to collect taxes. And that's how the whole economy is somewhat sort of connected together. So next slide, please. So just to sort of say that again, I think the most important thing here is the last line. Ledgers, in a sense, map out economic, political, and social relationships. So they're really, really, really important in terms of what they do. So next time you're sitting at your desk and you're bashing your head with your Excel sheet, bear in mind you're changing the economy in a positive way, just to give you a bit of motivation. All right, next slide. So let's just talk a little bit about, just carry on going very slowly, please, about the evolution of trust. So in the 16th century, we had the Medicis. This was a bank, an Italian bank, who realized actually there are lots of traders in a local market. However, there's no way of borrowing and lending, and I can set up a centralized market, and the Medicis basically set up the first local centralized bank where they had two sides of a ledger where they could borrow and lend against, and everybody was coming to them, and that's how the first bank was formed. And this is what we can call as an institutional bank. Next slide, please. And then if we fast forward to the sort of, the modern era, we have institutionalization of religion, of banks, of gas companies, etc., etc. Next slide, please. And then what are lessons we've learned over time? Typically, there's a lot of mistrust that happens in these centralized systems. So, we've had, next slide, please. Institutions have broken. So we had, oil companies, they've had spills, and they tried to hide things. We've had, money laundering and whatnot, sort of banks taking money from the users or the customers, et cetera, et cetera. Next slide, please. And then if we look at the digital age, all these companies that we use, Facebook, Google, sort of these data collection companies, what's happened recently with them? We've had lots of exploits, hacks, and vulnerabilities, our data essentially being stolen. And essentially, institutions are not designed for the digital age. We're still living in that 14th, 15th century where there is a lot of central party collusion that takes place, and trust has essentially been broken. Next slide. So what is next? So this is where, when I spoke to you about the underlying technology, where DLT, or distributed ledger technology, becomes very, very interesting in actually sharing that trust, not from with the help of an aid, across a network, and why it's such a powerful thing that's ignited crypto. Next slide, and that's where I've sort of put a few slides. Next slide, please. Just to give you an idea of what are the different types of networks as a background, essentially we have centralized systems, just one node in the middle, where it has its efficiencies. Where if you have one leader in the network, it's very fast and easy to send information and messages back to the other parts of the network. And then we have like a hub and spoke type of model, which is decentralized. A lot of people confuse decentralized with distributed. And then you have distributed, a network which allows from one corner of a network to another. It's about 17 hops for information to sort of pass through. But in your day-to-day lives, have a think about actual physical infrastructures. So in a decentralized one, maybe you can think about a rail system, which follows a hub and spoke system. So the point I want to sort of highlight is whenever you hear cryptocurrencies or payment systems, there is no one model that fits all, and that's a problem that people sort of confuse design of architecture with. Next slide, please. So what are some of the risks of actual centralization? So number one, being censored or banned from a system. Number two is charging unreasonably high fees to use the system. Number three, so changing the rules of the system. So many of us probably use Uber, for example. Uber fees have really shot up, but the investors behind Uber, they got to make their money back. So we didn't sign up to those original fees. We were accustomed to the low-cost fees and whatnot, and that's a sort of an example of centralized systems. And you can continue with that. Next slide, please. So where does cryptography, or where cryptocurrencies came from, the actual cryptography? So where does it come from? So typically you have in a centralized system, maybe you can think about an SMS system, how we send messages to one another. Typically, if I send a message to someone here in the audience, it goes to a third-party centralized tower, which will collect the message, and then it will pass it on to somebody else. In a crypto, which is one slide back, please. In cryptography, there are essentially a public key and a private key. Those are the only two sort of. It's an encryption method where you send the message, and only those two parties that have access to the keys can unlock that messages. So it's a peer-to-peer messaging system without a third party, and that's what cryptography is. All right, next slide, please. Next slide. We won't go into this too much for time. It's just about removing third parties. Just on here, so when we look at it from a financial services perspective, typically when we have to settle banking transactions at a retail or an institution level, there's typically a clearinghouse in between all of that. So at the end of the day, the central bank of a country says, give me all your ledgers and tell me how much money has actually come in and out. And that's a very a simple idea of a clearinghouse. In a distributed system, everybody who's part of the network actually owns the ledger. They have a copy of the database in their pocket. So there's no way of sort of saying that you don't have the same copy. And that's a very powerful thing when if I want to check how much money is in my bank, I need to send a message to my bank to understand how much is the balance of that. In a distributed system, everybody has access to the ledger. I don't need to seek permission from a third party to get access to my data. So that's really powerful as well. Next one, please. So just putting all of this together and how blockchain fits into all of this. So there is the concept that ledgers are everywhere, but they kind of need to evolve. And then there's the evolution of trust that we spoke about. And then from a network perspective, like the technology that brings all of this together. And that's the distributed networks. Next slide, please. Next slide, please. So let's just quickly go over how sort of a blockchain actually works. So a blockchain is as I mentioned, it's a transaction of records, or record of transactions rather, and they typically link in a cryptographic hash, which is the output of a one-way function that's easy to calculate but hard to guess. I promise you, in the next 5 minutes, you'll understand what this jargon all means. All right, next slide, please. So distributed ledger design. Next slide. All right, so essentially in a chain or a blockchain, you have a genesis block, which is the first block that's created, and then it sends the message in one way. So then you typically get another block that's created. Next slide. I just put my thumbs up for the next slide, yeah? All right, and then you get block 1. Then you get block 2, and then you get block 3, etc., etc. Next slide. And all the blocks have a one-way message, so you can't send a message backwards in time, which connects them all. And the important thing, the cryptography that I mentioned and how they're all connected together is this private key and the public key that connects them all together. So if you have access to somebody else's private key, then you can only sort of you can open the message again. But we're not going to talk into this, you just get a general idea. Next slide, please. And this is what, on a blockchain, it typically has a hash function on a transaction. That's what a hash function looks like when it's encrypted. All right, next slide, please. Next slide, this shows the transaction taking place. So, okay, next slide, thank you. So on a block, you have all the transactions, and all those transactions, when you add a new transaction, the state of the ledger changes, so you add a new block. And that block has the new transactions that's on it. And then you add block 3, 4, 5, as there are more and more transactions added to that change. So in summary, a blockchain is a distributed ledger confirmed and validated by blocks organized in an append-only chain using cryptographic lengths. Who thinks they understand some of that now? If you think about it for a minute. No? All right, I'm going home now. No? All right, fine. We'll just continue. Okay, next slide, please. Okay, let's talk a little bit about what is a consensus model, which people talk about in digital assets. Next slide, please. Next slide, please. Okay, so some of you might be asking, why is it only one way? So now we kind of think about why it's really important to have a consensus model in a decentralized architecture. All right, next. So as all these blocks are connecting, some of the smart people in this room might be asking, what happens when you have two transactions that came in at exactly the same time, right? How do you know which one should go in which order? And this is where you have a consensus model, essentially a rule which dictates which block should go in which order. So now if we kind of extend this, there's a rule in the blockchain sort of protocol, which is the longest chain is a truthful chain. So if you didn't manage to add a block to the chain, put it to the back of the queue. So when the Bitcoin blockchain is running, that's why you have validators in the network. They validate the order of the transactions. Let me show what happens in a little bit more detail. What happens here? Next slide, please. So this is a blockchain. Block number 1 is it's going through the net. Just slow down a little bit. So block 1 has gone through the network. Now we've introduced block 2 in yellow, and then block 2B, which has come at the same time into the network. So now the network has to say, oh, which model are we going to change? There's a clash in the network. So what happens is you add block 3. So now the network says, okay, block 3 is the longest chain. That's a consensus model. That's a rule behind this. We're going to take that to be the truthful one, and that permeates through the whole network. And that's all you get. That's why the blockchain is called the blockchain, where the consensus model here is the longest chain in the network is always the truthful one. And the miners in the network validate these transactions to be truthful. All right, next slide, please. Next slide. Okay, we can continue here. Not going to go into this too much. Okay, next slide, please. Okay, so now when we look at, this is a really important piece where we look at blockchain. There are two types. There is the permission space and the permissionless space. So permission blockchains are essentially more in the traditional enterprise use case. They're like, we love blockchain as a technology, but we don't like the cryptocurrency stuff or the open stuff. So in the permissionless space, it's open source kind of technology. It's like Bitcoin protocols. Anybody can access it. In the permission space, you need to have permission to access the networks. Okay, those are the two main from a theoretical perspective that you need to understand. Next slide, please. And in the permission space and the permissionless space, they all have different consensus mechanisms. So when you're reading a crypto paper, sometimes you'll see in the permission space, oh, it's a proof of work mechanism. Proof of work is where you have validators that need GPU power in order to prove the transactions. Or you have proof of stake, etc., etc. In the permission space, where there is a one-to-one relationship with the business partners, you don't need any consensus because there's already trust in the network. So the consensus or the proof is what you need in order to actually make this to be a trustworthy network. And there are different designs in different consensus mechanisms. All right, let's continue. And here are some sort of examples of different sort of consensus networks. Next, please. Okay, and here are some sort of projects that take place in this. So I can maybe touch on some of these. So in the open permissioner space, you've got some things like Bitcoin, Ethereum, Cardano, Zcash, etc. Then you have stuff in the middle. So you had Ripple and Stellar, where they're like, okay, we want to be in Hyperledger now, as Hyperledger, which was more Hedera, sorry. And then in the closed space, you had things like Corda, Maxomi, and Quorum, a little bit outdated, but these are sort of business or enterprise blockchains that companies are working together on. All right, next slide, please. Okay, we won't go into this too much. Next slide, please. So just to kind of understand when I told you how does money work in the space? So when you had those notes in your pocket, that's M0 money. That's been issued by the central bank. Then a layer above that, you have M1 money, which is actually retail or institutional money that's been issued by an investment bank or a retail bank. M2 money, that's more sort of payment systems. And then you have M3, M4 money. So just to give you a little overview of that. Next slide, please. And essentially why that's important is crypto or blockchain applications, you can kind of put them into 4 types of buckets. So now when you're kind of, I don't know, you're maybe the central bank of Cambodia, you have a problem of actually we've got a young and emerging population. However, we don't have the resources to finance our own blockchain technology, or we don't have the education and the knowledge. So you're going to have to choose which technology am I going to choose. And what you can do is essentially have 4 types of buckets where you have virtual currencies, which I sort of mentioned. Does my country, if I'm Cambodia, do I start to use cryptocurrencies as a payment system? Right now we're seeing a lot of failing countries around the world due to poor governance. So these are sort of choices they have to make. And then option 2 is it private sector money that I use? So you've got JP Morgan, you've got Goldman Sachs, all these sort of investment banks, they are all also issuing their own currency, which they use to transact between the businesses. And the third bucket is stable currencies. So this is where you had sort of projects like Libra that were there, you have USDC. This is the private company-backed money. So it's a company that's issuing their own money. And this is why it's highly political. And then right at the sort of permission space is central banking digital currency. So if you're Cambodia, do you say, I'm going to use the payment system of the Bank of England, or am I going to use the payment system of China, or am I going to use the US payment system? So this is a decision that many countries and governments around the world are having to play with, and it has lots of macroeconomic power plays at large. So this is how the money tree kind of comes together, and just to show you how some currencies in that, but I won't go into detail. Next, please. So actually, cryptocurrencies are still a very small market share compared to M1 money, M2 money, and M3 money. But many see that as an opportunity. So as people are losing trust in their governments or trust in their businesses, in businesses that store their data, you can kind of think about it, is the market share of cryptocurrencies going to increase or not? All right, next slide, please. Next slide. So now we'll talk a little bit about some applications on this technology, if we have time, but let's continue going. Okay, so you have 3 types of applications that you can build on a blockchain or a cryptocurrency. Essentially, you have a payment token, which is mostly what cryptocurrencies are. Then you have utility tokens, which is more like an application, maybe like an NFT, and then you have an asset token as well. So now you're kind of seeing real estate tokens sort of appearing on the market, and that's the legal sort of bucket of categories that smart contracts are put into. All right, next slide, please. So cryptocurrencies, they're synonymous with cryptocurrencies and no further functional links to other developments. Okay, it's a bit of a caveat. Next slide, please. So right now, an example of a utility token, this is a bit outdated, are NFTs. So people are, they're non-fungible, where you have a unique, you have a unique asset that belongs to you, and it's a digital asset that you can own in your pocket. Just to look at, this is a little bit outdated. What I was trying to do was, in 2020, I was trying to compare the market capitalizations and this whole thing about the evolution of trust. So the idea being, in 2006, we had predominantly the oil and gas companies that were the big companies of the time, and that was, around $20 trillion. Then in 2011, we could see, Apple coming through the ranks, and one or two banks also coming through the ranks. And that gave, in 2016, that's when, there's a whole tech sort of outpour during that time, and that's when the Facebooks and the Googles, the FANGs of the world came, and the market cap of those companies was just like double the existing market cap. And then now you look at today, like again, a little bit outdated, you look at sort of 2020, the market share is around $35, $40 trillion of those digital companies. Now, when we map this out to the cryptocurrency model, and now just think at the back of your mind, what I said, what a distributed ledger does. It's, it's a shared ledger, it's an evolution of trust, and it's all on a network. So one can almost kind of see, as the cryptocurrency markets, the question is, if you're an economist or a trader, you're like, is there actual utility and usage in these tools? And the data kind of says, yes, there is. So I think the next slide I put up, maybe in 5 years' time, we're going to see another one that's going to appear on top of those tech companies. You're going to see digital assets being very prevalent as part of our underlying sort of market. Next slide, please. This is more boring sort of data, but if you have any questions, we can talk about this later. Next slide, please. Next slide. So yes, I guess a nicer summary to those sort of things are what are sort of cryptocurrencies. It's essentially it's a innovative payment technology where it's an internet of money, where you can move assets from peer to peer just using an internet connection, a distributed information communications technology, et cetera, et cetera. But I think my favorite definition of what a cryptocurrency or the distributed ledger technology is, it's essentially a coordination technology. What it does is it creates very efficient marketplaces. So if you're thinking from an enterprise perspective, how we have very close silos of businesses that because we don't trust our competitors, it's not very easy to kind of collaborate with them. What this digital assets technology does is essentially creates very efficient marketplaces where participants who typically wouldn't trust or collaborate together, they can have a shared network where privacy is maintained and they can sort of collaborate on one marketplace. Next slide. Oh, that's my old one. All right, next slide. Okay, so if there are any, I'll leave it here. So I think the fact that many of you are not in sort of trading crypto, this is, if you're working in sort of financial services, this is where, on an enterprise grade, this is where the distributed ledger technology is currently disrupting the banking landscape. Lovely. I think I'll sort of conclude there. If anybody has any questions, if we have time, we can kind of take them.
Hello. Hello, hello. All right, thank you. Do we have any questions for Thamim? Yes. Oh.
No questions really, but when do you think all of this will come into life? When do you think the disruption would actually happen where we no longer need banks?
It's a $2 trillion market, so it's already here. It's a $2 trillion. So just to give an sort of understanding, it's almost at $2 trillion at the moment, the market cap of like crypto. So it's happening, and it's being used.
Thank you. Another question?
Okay, lovely. Thank you very much.
That's it. Well, thank you very much, Thamim. That was fantastic. A lot of information, a lot of insight. Thank you for the last. All right. Warm hand of applause for Mr. Thamim Ahmed, the London School of Economics. All right, ladies and gentlemen, and that's a wrap for day one of the FinTank stage sessions. Join us again tomorrow. We start at 10 a.m. See you then. Good night.